Hello everybody, welcome to another episode of EricksonTV. Curtis here with Lauren. Hello Lauren.
Hey Curtis, everybody.
Hey Lauren, I thought we would do maybe a back to basics review episode, but also with an updated article that was not research done by us, but done by a person named Alan Roth that wrote a book called How a Second Grader Beats Wall Street.
Okay.
So they're basically comparing passive index funds versus active funds.
Right.
And I was just before we get into the results, I was wondering if you could just do a real brief explanation of what the difference is of a passive versus an active fund.
Oh, sure. A passive versus so a passive fund is a fund that doesn't pick stocks and doesn't try to time markets, try to get in and out of things at the right time. Essentially, if you have a passive fund that invests in, say, the total U.S. stock market, then you're just invested in the total U.S. stock market. There's no picking and choosing going on.
Okay, all right. And even though it seems like I'm finding our prospective clients and clients seem to be a little bit more aware of passive or index funds,
right?
There still seems the predominant thing that you see advertised is active funds. So
yes.
In the media. Okay, great. So what this study did, and the thing I like about this study, originally it was done back in 2009, so it was done after we've had two really bad market crashes,
right,
in the early 2000s and 2008. But what they did is they compared picking funds, first just picking one single index, and then they compared that to an average of active funds, and then they did it over different time periods, and then they went on to having 5 different asset categories or 5 different index funds, and then they went all the way up to 10 different index funds.
Oh, okay.
And the interesting thing is I'll just do the difference between one fund versus 10 funds.
Okay.
So over a 1 year period of time, the passive fund beat active funds 58% if you just had one passive fund.
Right. Okay.
But if you
one
had
asset class.
Right.
Okay.
But if you had 10 asset class funds, you would have beat active funds over that 75%.
Even over 1 year. Oh, that's interesting.
Yeah, it was really interesting. And then if you go down to I'll just go out to 5 years of comparing the data. If you had one passive fund, let's see, you would have beat it 70% of the time if you had 5 different active passive funds. And then or if you had 10 funds, you would have beat it 91% of the time.
91%?
Yeah.
After 5 years only?
Yeah.
That's
and then I'll break it out over the 25 years. If you did it over a 25-year, and I think 25 years is reasonable for a time horizon because most people are retired. At least one of the spouses live more, at least that. So 88% of the time, your single passive fund beat the active fund.
Right.
And 99% of the time, your 10 funds beat the active fund. So what's your takeaway from that?
Well, I've heard those statistics for a long time, and I've used this in my class, but usually only in the one fund example. And that's usually what I say is that, I tell people that on the very first day of class, I'm going to teach you an incredibly simple method of investing that you can be fairly certain you'll beat 85% of investors if you use this incredibly simple, investing for monkeys, investing for idiots, whatever you want to call it. But I've never really thought about using. Of course, once you use 10 asset classes, you're not really doing investing for idiots anymore. Now you're doing something a little bit more complex.
I don't think a second grader can do that.
Right? Yeah, I'm not sure that a second grader can really put together a 10 asset class portfolio and rebalance it every year and all the rest of that. But I think it's an interesting. But it makes sense, and that would make sense because the more asset classes you have, the more difficult it's going to be for those active funds to outperform after expenses. If it's only one asset class, then the fund doesn't have to get lucky that many years, and it will outperform. But once you stack up all the asset classes, you really have to be guessing perfectly.
That's right. And then the other takeaway that I took from this is that this sounds self-serving, but we actually use 19 asset classes in our portfolios. And I think if an individual investor tries to do this themselves, be really careful on let's say the 10 funds you pick because they may not be dissimilar asset classes.
That's exactly right.
Right.
Yes.
All right. Well, thank you very much for Lauren, and we'll see you next time on EricksonTV.
See you next time.